Good day, folks, from stormy Niceville, Florida. This is your ticker guy, Carl. Again, you can see all of our stuff over at tickerforum.org. There is a huge group of very talented and intelligent people there. I'd love to take credit for the whole thing, but I can't. And there you will find all kinds of discussion about investing topics of various sorts. I'm putting this video out here today to disabuse a notion that you need managed money or you need some kind of investment manager in order to make a great deal of money in the market, or at least protect yourself from being ripped off raw. That is simply not true. Addition, I need to say that up front, I'm not a registered investment professional. I'm not an investment advisor. I do not hold any professional series license, and this isn't paid investment advice. It's worth exactly what you paid for it, and you need to do your own due diligence. Well, listen, this is an old-timer's investment timing signal that was shown to me by a grizzled guy about 20 years ago in Chicago. I used to live up there before I moved down here into sunny Niceville, Florida. And it is, I think, quite useful. It is for long-term investments only. It is not a trading tool by any stretch of the imagination. The goal, folks, as you probably know, is that you want to be fully invested in the market when it is in an upward trend, and you want to be out of the market or in cash when it is a downward trend. The problem for most people is that they tend to buy high and sell low, and that's exactly the opposite of what you're trying to do. So what we need is an objective way to achieve that goal, and we've got it here in the form of the 20 and 50 week, not daily, weekly moving averages. Again, this is a long-term timing signal, not meant for trading, not meant for short-term stuff. And by the way, 90% of short-term traders lose their ass. Okay, folks, let's look at how it is performed. I've got it up here on a chart. It would have had you exit the market in January at approximately the 1350 level, and the entry point was back here in 2003 at about 925. That is a return rate of approximately 70% over that period of time. We'll back up a little further. Notice here that the 2006 slump did not have you exiting the market. Okay? And also the slump here in 04 did not have you exiting the market, although there was a crossover. It was not by more than 1%. By the way, guys, that is the filter rule, is that the cross must be by 1% or greater to count. A touch does not count. You check this once per week. No more often is necessary or helpful. During the bear market from 2001 through 2003, you'll see that the 20 was solidly below the 50 by more than, and again, the approach here does not count. It has to cross by more than 1%. You were in cash this entire time. You didn't lose any of your money. Congratulations. If we go back here and we look at when it had us in, we were in for the entire bull run during the technology boom, including this drop here during 1998 when a lot of people sold out only to get screwed as they sold at the bottom and then didn't re-enter until after they were all the way up here. You missed the recovery. You missed the whole thing if you got out in the middle of 1998, and you missed the blow-off into 99, which of course was when a lot of money was made. You actually entered this position back in 1995, and you stuck with it through the entire run. If we go back even further, we find that it works even during longer periods of time. As you'll see, in 1991, it had us entering here at about a little over 350, and we stuck with that all the way up here to about 450 when it had us exit. Okay, that's not a bad run either over a couple of year period. The other thing that's interesting about this is that it has you in almost always for more than 12 months, which means that you get long-term capital gains tax treatment. How much more efficient is this? Well, from the start of the 1995 bull market all the way up until recently, if you followed the timing signals, of which there was the entry in 1995, the exit in 2001, the entry in 2003, and the exit in the first part of this year, you would have been up more than 40% ahead of just buying the index in 1995 and sitting on it. And that's a big difference, guys. You would have made approximately 20% per year return as opposed to 14% simply buying in 1995 and holding on. The bad news is that it would have kept you, and here's where people mostly make mistakes. During the 2001 to 2003 bear market, there were lots of times that it looked good as a time to buy stocks. In fact, they were horrible time to buy stocks, including here. If you bought in here thinking that the recovery had started, you simply got crushed. There are a lot of people that made the mistake of buying on the way down, but they didn't catch the actual bottom. Notice that if you bought at anything below about 925, you got screwed compared to the signal. But how many people caught the bottom between 800 and 925? A lot of people say they did, but did they really? Or did they buy up here in the 1100 area only to see their returns decimated? The goal here, folks, is to be in the market again during bull runs and out of the market during bears. And that's the only thing that really matters. If you can do that, you will beat the index handily by about 40% on average. That is far better than essentially any managed mutual fund. And your money is 100% safe in cash during the bear markets. Since bear markets are about 20% of the time, this drops your beta or your sensitivity to risk as well. So you actually outperform by considerably more than it first appears, in that you take less risk than the person who simply stays invested. If we go back and we look at other periods of time here and longer time frames, you'll see that this signal works extremely well even in the past, going back further. In the 1980s, it kept you in during this run here. It had you out doing this little dip, and then it had you back in the market. It had you in the market during this entire run here from 1985 all the way up to the dislocation in 1987. Well, it did not warn you of the 1987 crash in advance. That's okay. You still made a whole bunch of money all the way up. It had you out of the market during the bear market from the mid-1981 to late 1982 time frame, and yet it had you in the market from the late 1982 time frame until the crossover here in 1984. This huge bull run was entirely captured. You made all of the money there. If you go back and you check this, you'll see that it works over other periods of time too. It got you out of the market and kept you safe during the 1973-75 bear market, which was a vicious bear, cut nearly 50% off of people's accounts, okay? From 110 all the way down here to 65. That really sucks if you got in on the wrong end of that. And yet it had you back in the market here right about the 82, 83 level, and had you in all the way up here to right around 100. That's not bad. 15% return in a year and a half. I'll take it. Okay? No, it does not catch every move. No, it does not catch everything. There have been a few whipsaws that have been false exits. But the truth of the matter is those false exits don't cost you much. And over long periods of time, being whipsawed once or twice in your investing career, which is going to span 30 or 40 years, isn't all that bad. It keeps down your commissions. It keeps down your capital gains tax. But it doesn't make any money for the brokers, which is why you will never see this on CNBC. You will never see this in Barron's. You will never see this in any of the other places where all of the brokers and dealers advertise. Why? Because they're more interested in making money than you are. Do your own homework, folks. It's not that difficult. If you want to trade actively, you can come over to tickerforum.org and talk with us. There's a lot of people there. I'm not the only one posting by any stretch of the imagination. Yeah, I speak up once in a while. If you want to take a look at what's going on in the world of investing, there's always market-ticker.denninger.net. Usually daily commentary, sometimes a little more, sometimes a little less. But if you're just interested in running your own money and keeping it safe from the bear markets, this is not a bad signal. Do your own due diligence, take responsibility for yourself. Your results and how you manage to perform is not up to anybody else. It is only up to you. That is another thing you won't hear on CNBC. Have a great day.